Hello and welcome to a new edition of Value Investing Decoded. With me today is one of the top fund managers in India. He's been one of the top fund managers in India for a long time now. Not just the top in terms of the size of funds that he manages overseas, but also in terms of the performance over a very long period of time. And that is important, time. You get hot shots coming up, popping up all over once every few years, but few have managed to rival his track record with the amount of money that he oversees. I'm talking about Prashant Jain. He's Chief Investment Officer at HDFC Asset Management Company. So thank you very much for your time.
Pleasure.
It's a pleasure to have you with us here.
My pleasure.
I have a very simple question for you.
Yes.
How do you do it? I think our viewers just want to know the secret sauce, if there is one.
I think the key is that stick to reasonable quality, remain reasonably diversified, and think long term.
Okay.
It sounds simple, but it's a bit more tough to actually do it.
Okay, so let's break it down a little bit. How do you come upon an investment idea? Let's take it from there.
I think
how do you decide, well, okay, I should explore this a little bit more?
So I think that is fairly easy to answer because we have a core list of companies which is fairly large. There is a large team, and we have allocated divided our research along sectoral lines. So I think the team is doing a fairly good job, and we are exploring continuously what are the new companies which are not under our coverage in the respective sectors, and the team is adding new ideas to our core list. I think today it would be fair to say there aren't too many companies of meaningful size which are not covered by our research.
Okay.
So I don't think we are looking at new companies per se which we don't understand.
I think that is a very simple but a basic thing for a lot of investors to do, right? To learn what not to do or what not to buy and sort of shoot too wide. Stay focused, I think, is an important message because you've got all these companies listed. Would you say, how many are investable really, according to you? What is the number?
I think around maybe 400 odd companies, or if you stretch it, maybe outside 450 companies, I think are investable in my opinion, based on our understanding.
Over a long period of time. These are
this number has grown. This number has grown as new companies get listed. 10 years back we used to cover maybe 200 companies. Today we are covering about 350, 400.
At what rate do stocks exit this list as well? Or once?
I think the exit rate is quite less because if you focus on businesses which are sustainable, which offer a certain minimum threshold of quality, the exit rates happen typically when a business is merged or it is delisted.
Okay. Not because the underlying thesis was wrong or, stocks just...
No, but this is not a buy list.
Yeah.
See, that is what I was trying to explain. This is a list of companies which we think we understand.
Okay.
This is our investment universe.
Okay.
So you will not buy all of these companies. You will buy a handful, much smaller number of these companies will comprise the portfolios. Okay. Based on what looks better in an absolute and in a relative sense.
So stocks, in terms of your buy list will be from this broad 400 odd stocks, but they'll keep moving, right?
Absolutely.
Some make it to the buy list, others fall relative.
That is left to the individual portfolio managers.
Absolutely.
What they like from within this list.
Okay.
So that is a decision which is specific.
And if I were to ask you broadly, are these, what percentage of these stocks are consumption oriented broadly? And how many of these are infrastructure and that kind of?
I guess that would, in terms of market capitalizations, it would very broadly track the markets itself.
Okay.
So the consumer companies, the consumer non-discretionary companies are maybe 15% of the market. So that is what this list would also represent, because please understand, 400 companies means that we are practically covering 90% of the market capitalization.
Sure.
So our distribution of companies will not be different from the market itself.
Okay, but if you just take the Nifty 50 for example, you basically cover 80% of the market, right, in terms of market capitalization.
So that's what I said. The moment we are at 400 companies, we are covering
practically the entire
90 or 95% of the whole
of the market.
Yes.
Okay, so you got a set of stocks that you want to track, right? And I think that is important in terms of what to decide to look at, right? That's a basic. After that, how do you go about evaluating prospects of a company? What is important to you? The key, the basics, basically.
I think the key is something simple. It's easy to say it and hard to practice it. A business which offers you a minimum reasonable quality. So you don't want to buy a business which you believe is of really poor quality, either in terms of business or management or both. So I think that excludes a certain type of.
Let's break it down, business and management. What do you mean business quality?
Business quality means sustainability of the business, the comparative advantages. Do you think that business will continue to survive after 10 years, 15 years? Does it have some inherent comparative advantages?
Okay.
So not every company can have great brands or great technology. So that's why I said I use the word reasonable. Okay. I did not say if you set the barrier too high,
okay,
then maybe you will figure out there are only 50 companies which will pass the
threshold.
test. Yes.
Okay.
And same for managements. So managements which have a certain basic minimum reasonable competence and integrity to manage them.
And how do you assess that?
It comes mainly by looking at the track record of the company.
The financial track record.
The financial track record, by talking to people who are part of the same industry.
Okay.
So markets also have an opinion on the competence, integrity of different managements. And I think by and large the markets are quite, they have a fairly good sense of how things stack up.
Do both always go hand in hand? I mean, if you find a management, a company with great business track record, financial track record, generally speaking, the business, the management also has a great track record. I mean, they can vary as well.
See, generally, if a business has a good track record, then it means that it has been a well-managed business. So there should be a very high correlation between both business performance and the management competence.
Okay. If we dig a little deeper into sustainability of the business, what are the most important financial parameters that you look at?
I think ROC, return on capital employed, will be a very simple and a very effective tool.
Okay. Could you explain what does ROC mean and what does it measure?
So ROC is simply return on capital employed. So how much capital is invested in the business and what are the returns being generated on that.
Okay.
And any business which does not have comparative advantages will normally fail to deliver a decent ROC. The cost of capital in India is, let's say, ballpark 15%. And any business which is generating more than 12-15% ROC over long periods of time, it suggests that there are some inherent comparative advantages which a business has, and which is what has enabled it to earn the higher than cost of capital returns.
Doesn't ROE also do the same thing? I mean, a lot of people that I've spoken to said they look at return on equity pretty closely.
Yes, so but the invested capital could comprise of both debt and of equity.
Okay.
So
that's the critical difference between.
Yes, so if you have 100 crores invested in a business, it may be comprised of either net worth, which is equity capital, or it could comprise of the debt borrowings. And the cost of these two different types of capital is different. So that is why I said the cost of capital, I mean the return on capital employed, because that will not distinguish between a company which has debt and which does not have debt. But ROE is also a very equally effective measure.
So the 400 companies that you spoke about, is there a minimum threshold that these companies have?
No, we have not kept a threshold in terms of size.
Okay. No, not in terms of size, but in terms of earning a certain return on capital employed.
Yes, but it is also slightly subjective, because sometimes a business may have passed through very challenging times. It could be a cyclical. But yes, over medium to long periods, if that minimum threshold is not there, then chances are it would not be there in the core list, unless you believe that something is changing and the future will be different from the past.
But so what is that minimum, generally speaking, a mental number that you have?
There is no minimum, but I would say, I mean, a 12% return on capital employed.
Okay.
Below that, businesses would not make too much sense.
Okay. Anything else, any other financial metric which is important to you?
I think this is quite effective. Either ROC or ROE. I think this is a very simple tool.
Okay. And you said that you look at, I mean, when we say look at the track record, what periods do you look at?
I guess the last 5-10 years is quite relevant. I mean, what happened 30 years back is probably not as relevant. A lot of things change. But I think the last 3, 5, 10 years is I would say that should be sufficient.
Okay. I mean, it should have seen at least 2 market cycles, I mean 2 cycles in the economy.
Yes,
So
10 years is a reasonable time.
reasonable time,
Yes.
time frame. Okay. Are there any other criterion business-wise or finance-wise, management-wise or
I think
financial metric
management
wise?
is a more subjective assessment. But I told you can look at the board of directors, you can look at the auditors, you can look at how much taxes, how much dividends the company has been paying.
Let me ask you a simple question. This might sound funny, but have there been any businesses which have earned, say, 15% plus return on capital employed for the last, say, 10 years? And you found this business trading at attractive valuations. You've decided not to buy it for management considerations.
I don't think we have come across such a business so far. Even if it is there, it does not come immediately to my knowledge.
How do you decide what is the right price to pay? Let's come to that in terms of valuations.
See, I think that's the tricky part, and that is where most of the challenge is. And I have seen that markets typically extrapolate the short-term growth rates to the long-term.
Okay.
And that is where the markets kind of gets it wrong, at least over the short periods. So if you go back and see in late 90s, the technology companies, the TMT so-called companies were very, very expensive, because the markets simply said that these growth rates of 60-100% are sustainable for very long periods.
Okay.
And so markets was paying a very high price.
Okay.
And it was not the case. I mean, subsequently the growth rates came off, and today if you see, after 15 years, those companies which were trading at 300 plus PE multiples then are trading at 30 PE multiples. So markets got it terribly wrong. And at the same time, when markets are very focused on a particular segment of the market, they tend to sell out or lose interest in other segments of the markets. And that is where you could find good value. And that is what happened to old economy stocks in late 99, early 2000. That everything other than the TMT was very, very cheap.
Okay.
And something similar was witnessed around 2006-07. When the markets, I guess, driven by the very good capital expenditure cycle, drove up the infrastructure, some related sectors to very, very high levels. And if you look at hindsight, no one will probably believe that these companies had these kind of market capitalizations. And some of these companies had market capitalizations much more than the consumer staple companies also. And of course, subsequently they have lost 90, 95, 99% in valuation.
Yes, yes.
So then again, since market was very focused on consumer companies, on infra companies, other segment became very cheap. I think that is, if you think long term, it is easy to get this right, but it is very difficult to think long term, because what may work over 3 years may cause you a lot of pain over 3 months, 6 months, 1 year periods also.
Okay.
So I think it's not such a easy
determining the value of the business, say 10 years out, and then valuing it now, essentially.
I think most people would agree on the value of a business, but it is just that I think they don't, they want to time it better. And what is working, what is making money today is very hard to ignore, and what is not doing well is very hard to bring it to your portfolios. And that is why, I mean, value investing as it is, as I understand, is very difficult to practice.
Yes.
Because it causes a lot of pain in the
short term, in the medium term, maybe for a long term as well. I mean,
short to medium term.
Yeah, and it takes very long to pan out. Typically,
I would not say it takes very long, but if I guess a three-year period is reasonable in my experience.
But in India, would you say most are by going by the definition, most people are growth investors. This is a growth market. Value investors, the definition, I mean, you can count them on your fingers, the prominent ones that practice.
See, I don't think it is such a easy classification to make, but yes, I think there is the majority of people, I would say, they tend to buy fast growing companies, and that is why the markets, I have seen more than once, it tends to overvalue growth at a point of time, not at all points of time, but at a point of time.
Okay.
And then
Gets overdone. How would you describe yourself? Are you, is it a mixture of both for you?
I would say, we take a balanced view of the markets. So the closest that would come to my mind is growth at a reasonable price.
Okay.
See, ultimately, if a business is not growing, it is very hard to make serious money on it. Once in a while you can get a very deeply undervalued business which is not growing, and you may make some money. But ultimately, I think for a long-term investor, growth is very important, growth of the business.
Right.
So I would say we also like to buy growing business, or I like to buy growing businesses. But I take a more longer-term view of the sustainable growth rates of the business. And I don't want to at least meaningfully overpay for what growth I think the business is capable of.
Are there any sort of like the financial metric we spoke about, some things you look at to kind of determine what could be potential growth rates, or it's mostly all qualitative?
No, I think that is where your research, your thought process, all of that has a role to play. And there have been, I think we have by and large got long-term sustainable growth rates right. So I think that comes from lots of experience, research, understanding, thinking, discussing with experts, understanding what is driving growth today. Are these factors sustainable? To what extent in the future?
You did mention competitive advantage is a big factor right in the beginning. That is when you do your work and you do your research, is that one of the primary things? Will they have this advantage on a sustainable basis going forward as well? That's what you want in a business, right?
Yes, yeah. So I think that's fairly easy to understand, and most people would. So if a company has a brand, I think most people understand it gives you some competitive advantage. Size, scale of business, having been doing something for a while itself gives you a competitive advantage. So I think that part is fairly well understood. But of course, what is happening now is that we are seeing many disruptive models.
Yes, I was coming to that. Yes.
So we are seeing new technologies, and so what we thought would be a sustainable advantage till yesterday may not be there to that extent, at least 5 years down the line. So I think even that part is becoming a bit more challenging now.
You think that is over? And by the way technology is changing, according to some, it is not about the next some 20, 25 years. A lot of new things, completely dramatically new things can happen in the next 10 years. Is that a big challenge, trying to figure this out?
Yes, I think it is. I would not say it is a big challenge, but these things will not happen overnight. At least they will give you 3-5 years, or maybe hopefully.
And I'm not talking
longer.
about some new age businesses. I'm talking about, say, automobiles, for example.
I think a lot of businesses are facing threats from very different quarters and threats which are of a very different nature. So automobiles you mentioned is one. Even I would say brands could become less relevant as we go along, because what is the internet doing? What is e-commerce doing? It is giving a huge distribution platform to lesser brands. So on the web, the shelf space is unlimited.
Yes.
And a click can take you from this brand to that brand. The price comparison is very easy, and users are commenting on their experience of the brand.
That becomes more relevant instant.
And millions can see that, experience that. So I think I feel it is possible that even brands they offer less competitive advantages into the future than what they have offered so far.
In the past. The comfort of a brand basically, generally speaking,
the physical
goes
constraints, the benefits of scale, the difficulty of new brands to connect with the customer, the web is breaking all these barriers.
Yes. Any other businesses you can think of where this kind of plays out? And also talk a little bit about autos, where you sort of agreed with.
So I think the issues are known to everyone, but I don't think I have a great answer or a great view. But I have seen that if you keep on thinking, keep on improving your understanding of a subject, if you are alive to the risk, then over time you will you are likely to take a correct view of things. So I don't have any great answers, but I am alive to these risks.
Possibilities.
Yes.
And how they might pan out. Okay. Just going back to buying growth at a reasonable price. Again, is there in terms of PE or do you say, well, okay, I'm not going to buy 40, 50 PE type of stocks. I mean, it doesn't make sense. Or you're okay with those kind of numbers as well if they're giving you great growth opportunities.
This is where it becomes a bit more challenging to discuss, because a 40 PE for one company might be very cheap and a 15 PE for a different company might be very expensive.
Right.
Because these two companies may offer very different growth rates into the future and for very different periods of time. Right. And so that is where it becomes a bit more challenging to discuss. So you can't really put a number to this. A company which is at the bottom cycle of earnings and offers great growth possibilities might be cheap at 40 PE, and a company which is sitting on high margins, less sustainable margins, at 15 PE may be more expensive.
More expensive. Okay, let's come to the other part. When do you decide to sell? How do you decide, okay, this is it, I want to get out?
See, it's, I mean, we are managing mutual funds, so, and by and large we have refrained from taking cash calls in our portfolios. And so far that has worked quite well. So what we are, ideally one would like to have businesses which offer you absolute values. But being a mutual fund manager and being our objective is to deliver returns superior to the benchmarks.
Sure.
So we focus on relative value also. So I would say it is up to the individual manager, the respective managers of the funds, how they trade off or look for absolute versus relative value. Because the farther you move away from the benchmark, the more risk you are taking against the benchmark. I think that is where the touch and feel or how an individual thinks comes into play.
But personally, if your idea is to go after absolute returns, and you don't, in the mutual fund business, you have to look at relative returns as well. That's the nature of the business. But in absolute return type situations, how should one think about when to take money, how to take profits?
See, I think when something has become so expensive that it does not offer you meaningful gains over fairly long periods, or when some other businesses which are meaningfully more attractive over the long term. In either of these two cases, that is when one should sell. See, whatever I am saying, this is known to, I mean, this is a very general answer, and it does not, and that is why this business you have to learn by doing it. So there are no textbooks.
No shortcuts.
I mean, you have to experience, make mistakes, fall, learn, move on. That is how you kind of get to understand these things. And even people who have 20, 30 years of experience, even they make mistakes.
Sure.
So that is clearly telling you that business is, that this is a very dynamic field. You are constantly making mistakes, but hopefully as you gain in experience, you make lesser mistakes than people who are less experienced on an average.
You know, I was reading somewhere that you said, I mean, actually, it was something written about you, that one of the simple reasons why you have a long-term track record is because you've not made big mistakes. And I think that is a pretty important thing to do, not to lose a large portion of your capital permanently, right? I mean, that over a period of time will seriously impair what you can make, your returns over a period of time.
Yes, so I made such a mistake right at the beginning of my career.
That is always advisable, right?
So yes, so I was fortunate to have heard very early on, way back in 94, 95. And that is what has helped me.
What was that mistake?
So we invested in very unsustainable businesses,
right,
which were very cheap to look at. But after some time we realized, me and my colleagues, that we have made a mistake. So we got out at a loss, but since then we have focused on a minimum threshold of quality.
Okay.
And since then I would say that yes, I mean, we may not have bought the best businesses which have delivered the best returns,
right,
or might have missed many companies which have done well, but I think we have not, at least the funds have not lost any
serious money. And yeah, that is always important. Prashant Jain, thank you very much for your time. I hope our viewers learn a lot from you.
Sure,
thank you
sure.
indeed.
Thank you.
Thank you.